It happened again. On February 5th, 2026, at exactly 9:47 a.m. Eastern Time, the Bitcoin market experienced what would become the largest single-day capitulation event in cryptocurrency history. Not a hack, not an exchange collapse, not a regulatory crackdown. A $3.2 billion transfer of wealth. $3.2 billion in realized losses in 24 hours. Let me be crystal clear about what that means. Real people with real money sold Bitcoin at real losses. These aren't paper losses we're talking about. These are actual crystallized, documented transfers of wealth. To put this in perspective, when FTX collapsed and Sam Bankman-Fried's empire imploded, it triggered $2.8 billion in realized losses over 3 days. When Terra Luna death spiraled and wiped out Do Kwon's algorithmic stablecoin experiment, investors crystallized $2.4 billion in losses over an entire week. When China banned Bitcoin mining in 2021, triggering a global hash rate migration, the capitulation totaled $1.9 billion. This single day, February 5th, 2026, surpassed all of them in 24 hours. But here's the question worth asking. Was this simply market forces at work? Or does the pattern suggest something more systematic happening beneath the surface? Because what happened next raises some fascinating questions. While retail investors were panic selling at $60,000, certain entities were accumulating. While Twitter was exploding with Bitcoin going to 50K and sell now or lose everything, institutional wallets were filling up. While the fear and greed index crashed to levels not seen since the FTX collapse, BlackRock's Bitcoin ETF was quietly registering inflows. Today, I'm going to show you the data trail, the pattern recognition, the wealth transfer mechanism. And I want you to draw your own conclusions about whether this represents natural market behavior or something more coordinated, because it all connects to a research report from Standard Chartered Bank. On February 12th, 2026, exactly 1 week after the crash, Standard Chartered published their revised Bitcoin outlook. They lowered their year-end 2026 target from $150,000 to $100,000. But that wasn't the headline. The headline was this quote: "In a worst-case scenario, Bitcoin could retest support at $50,000 before resuming its long-term uptrend. $50,000, a 40% drop from the $70,000 levels where Bitcoin was trading just days before." Now, Standard Chartered isn't some random crypto blog run by anonymous 22-year-olds. This is a $270 billion banking institution. They manage money for hedge funds, family offices, sovereign wealth funds. When they speak, markets pay attention. When they publish research, institutional clients take note. And this wasn't their first time making dramatic Bitcoin predictions at interesting moments. Let me show you their track record, because once you see the full pattern, you might start asking questions. If you're starting to see something interesting here, drop a comment right now. I see the pattern. Let's see how many of you notice what I'm about to show. March 2021, Bitcoin trading at $60,000, approaching all-time highs. Standard Chartered publishes Bitcoin to 100,000 by end of year. What happened? Bitcoin topped at 69,000 in November, then crashed to 35,000 by January 2022. They were bullish near the top. November 2022, Bitcoin at 15,500 after FTX collapse. The industry is in complete fear. Celsius, Voyager, BlockFi, all bankrupt. Standard Chartered publishes Bitcoin faces further downside, could test 12,000. What happened? Bitcoin bottomed at 15,400 and never went lower. It rallied to 30,000 by April 2023. They were bearish near the bottom. December 2025, Bitcoin trading around 89,000 after hitting 103,000 peak. Standard Chartered, we're lowering our 2026 target from 300,000 to 150,000 due to slower institutional adoption. The revision cuts their forecast by 50%. What happened? Bitcoin consolidated and institutions continued accumulating through ETFs. And now, February 2026, Bitcoin at 72,000, trying to recover after the October 2025 all-time high of 126,000. Standard Chartered, lowering year-end target to 100,000. Could drop to 50,000 before recovery. Notice anything interesting about this pattern? They lower forecasts after major declines, when fear is already elevated. They raise forecasts during rallies, when optimism is building. One could argue they're simply reacting to market conditions. Or one could speculate that the timing creates interesting opportunities for certain market participants. Before I show you the data that suggests who might benefit from these patterns, hit that subscribe button. This channel exists to analyze the mechanisms of wealth transfer in markets. Make sure you're subscribed so you don't miss the analysis. Because here's a question worth considering. Who are Standard Chartered's primary clients? They're not retail investors making $100 Bitcoin purchases. Their clients are institutional custody services, prime brokerage for hedge funds, treasury management for family offices, investment banking for corporations, structured products for high net worth individuals. When Standard Chartered publishes a report suggesting Bitcoin could go to 50,000, who might find that information most valuable? Their institutional clients who want to accumulate at lower prices. When they published Bitcoin to 100,000 in March 2021 at 60,000, who might have benefited? Their institutional clients who wanted to distribute at higher prices. This isn't an accusation. This is market structure analysis. Banks create research. That research serves their client base. And their client base consists primarily of large institutional players who need liquidity to execute sizable orders. The question becomes, where does that liquidity come from? Let me show you what the data reveals. This is the Glassnode realized loss metric. For those unfamiliar, this doesn't measure unrealized or paper losses. This measures actual losses crystallized by investors who sold Bitcoin below their purchase price. Real money, real losses. Real capitulation, red bars indicate selling at a loss. Large red bars indicate panic selling. And this bar from February 5th, this represents a massive transfer, $3.2 billion. According to on-chain data verified by multiple sources, including CoinDesk and Glassnode, this single-day realized loss exceeded every major capitulation event in Bitcoin's 17-year history. FTX collapse, November 2022, $2.8 billion over 3 days. Terra Luna implosion, May 2022, $2.4 billion over a week. China mining ban, May 2021, $1.9 billion over multiple days. COVID crash, March 2020, $1.6 billion. The scale wasn't gradual, it was explosive, it was concentrated. Here's what the price action shows. February 4th, Bitcoin trading at $70,200. Market relatively stable. Fear and greed. Index at 26, neutral to slightly fearful but nothing extreme. February 5th, early morning, Bitcoin begins declining. By 9 a.m. Eastern, price is at 68,000, still holding support. Then something interesting happens. Between 9 a.m. and 2 p.m. Eastern, Bitcoin collapses from 68,000 to 60,100. An 11.6% drop in 5 hours. But here's what stands out in the volume data. This doesn't look like gradual distribution. This doesn't look like slow, methodical profit-taking by long-term holders. The volume bars suggest concentrated selling. Large orders entering the market simultaneously. According to CoinGlass data, over $1.26 billion in leveraged long positions were liquidated on February 5th alone. Traders betting on Bitcoin going up had their positions forcibly closed by exchanges. Those forced liquidations became sell orders, which pushed price down further, which triggered more liquidations. A cascade effect, a pattern that sophisticated traders call a liquidity hunt. And social media? Twitter exploded in real time. Bitcoin going to 50,000, Standard Chartered never misses. Sell now or lose everything. This is 2022 all over again. The bull run is over. Bears are back in control. Fed hawkishness is killing crypto. Get out while you can. The sentiment was overwhelmingly fearful. The crypto fear and greed index, which measures market sentiment on a scale of 0 to 100, crashed from 26 to levels between 5 and 9 depending on the tracker. According to data from alternative.me and confirmed by multiple sources including CCN and CoinMarketCap, this was the lowest reading since the FTX collapse in November 2022. Some trackers showed it hitting as low as 5. Others showed 6 to 9 depending on methodology. But all sources agreed this represented extreme fear. And here's where the pattern becomes interesting. Extreme fear below 12 has historically coincided with market bottoms rather than market tops. COVID crash, March 2020. Fear index hit 8. Bitcoin was at 3,800. 18 months later, 69,000. An 1,800% return. China mining ban, May 2021. Fear index hit 10. Bitcoin was at 28,000. 7 months later, 69,000. A 146% return. FTX collapse, November 2022. Fear index hit 6. Bitcoin was at 15,400. 21 months later, 73,000. A 374% return. And now, February 5th, 2026. Fear index between 5 and 8. Bitcoin at 60,000. The historical pattern suggests these extreme fear readings have preceded recoveries, not declines. But retail didn't buy during this extreme fear. The data shows retail sold. $3.2 billion in realized losses proves it. That's $3.2 billion of Bitcoin that transferred ownership, from sellers experiencing fear to buyers willing to accumulate during panic, from emotional decision makers to systematic accumulators. The question worth asking, who was on each side of that transfer? If you've ever sold during extreme fear and regretted it later, comment, I've been there. This is a judgment-free zone. We're analyzing patterns, not judging decisions. But the data reveals something even more fascinating. While this selling was occurring, while retail was capitulating, while the fear index was at historic lows, certain entities were accumulating. Let me show you the institutional footprints. On February 11th, 2026, while Bitcoin was still recovering from the February 5th decline, the Dow Jones Industrial Average hit an all-time high of 50,188. Consider that for a moment. While Bitcoin was down 52% from its October 2025 peak of 126,000, traditional stock markets were hitting record highs. This raises an interesting question. What explains this divergence? Historically, Bitcoin and the stock market tend to move together during macro events. When the Federal Reserve raises rates, both assets typically decline because higher rates make risk assets less attractive. When there's risk-off sentiment in markets, both Bitcoin and stocks tend to fall together. But in February 2026, they moved in opposite directions. Bitcoin down 52% from peak, Dow hitting all-time highs. One interpretation. This represents different risk appetites across asset classes. Another interpretation worth considering. This represents capital rotation and strategic positioning. Here's a pattern that emerges from the data. Large institutions face a challenge when accumulating positions in Bitcoin. Unlike traditional markets with deep liquidity, Bitcoin's market depth is more limited. If a major institution announces, "We're buying $10 billion worth of Bitcoin," the price typically rallies before they can execute their full order. This creates a potential incentive. They might benefit from accumulating during periods when others are selling. So the question becomes, how might one create an environment where others are willing to sell? One hypothesis: through information that increases uncertainty. Research reports suggesting significant downside, media coverage amplifying fear, retail participants making emotional decisions. And while this is happening, patient capital accumulates. Is this what occurred in February 2026? Let's examine the institutional data. BlackRock's Bitcoin ETF, ticker IBIT. According to Farsight Investors data, on February 10th, just 5 days after the crash, IBIT registered net inflows of $26.5 million. On February 11th, additional inflows. The week of February 10th saw Bitcoin ETFs collectively record $166.5 million in net inflows according to multiple sources. This represented the first back-to-back positive flows in over a month. Consider the timing. Bitcoin crashes on February 5th. Retail appears to panic sell based on realized loss data. Fear index hits historic lows. And less than a week later, institutional ETF flows turn positive again. Fidelity's FBTC, similar pattern observed. After weeks of outflows, inflows resumed in the second week of February. Grayscale's GBTC. The consistent outflows that had persisted for months stabilized to near zero by mid-February. Strategy, formerly MicroStrategy, Michael Saylor's company, which holds more than 3.4% of all Bitcoin in existence, continued accumulating. Between February 2nd and 8th, Strategy acquired 1,142 Bitcoin for $90 million at an average price of $78,815 per coin. On February 10th, Michael Saylor appeared on CNBC. When asked about concerns that Strategy might be forced to sell Bitcoin due to price declines, he stated, "That's an unfounded concern. We've got 50 years worth of dividends in Bitcoin. We've got 2.5 years worth of dividends just in cash on our balance sheet. We're not going to be selling. We're going to be buying Bitcoin. I expect we'll be buying Bitcoin every quarter forever." Every quarter, forever. Even if Bitcoin experiences severe drawdowns, Saylor confirmed Strategy's accumulation strategy continues. So while the data suggests retail was selling in fear at 60,000 based on realized losses, institutional players were demonstrably buying. While Twitter was amplifying fear, capital was rotating from retail to institutions. While the fear index was at 5, systematic accumulation was occurring. This pattern raises questions worth considering. If you're starting to understand how this wealth transfer mechanism might work, hit that like button and drop a comment. Pattern recognition. That's the key skill in analyzing markets. But here's what makes this particularly interesting: the recovery speed. February 5th, Bitcoin hits 60,100, maximum measured fear, 3.2 billion in realized losses. February 6th, Bitcoin recovers to 65,000. February 10th, Bitcoin back at 68,000. February 12th, Bitcoin at 70,200. In 7 days, Bitcoin recovered almost all the losses. The fear index climbed back to 12. The panic evaporated as quickly as it appeared. And the entities who accumulated at 60 to 65,000, they're already showing unrealized gains of 5 to 10%. The retail participants who sold at 60,000 based on fear, they've locked in permanent losses and are now watching the price recover without their participation. Many are likely paralyzed by the psychology of not wanting to buy back higher than they sold. This represents what market analysts call the Marcus versus Victor dynamic. Let me illustrate with two hypothetical participants that we'll explore in detail shortly. This pattern with Standard Chartered isn't isolated. Let me show you their complete Bitcoin forecast history because the data reveals something worth analyzing. 2021, March. Bitcoin at $60,000. SC publishes Bitcoin to 100,000 by end of year. Result, Bitcoin tops at 69,000 in November, crashes to 35,000 by January 2022. Forecast was bullish near market top. 2022, November, Bitcoin at 15,500 after FTX collapse. SC publishes bearish outlook. Could test 12,000. Result, 15,400 was the exact bottom. Never went lower. Rallied to 30,000 by April 2023. Forecast was bearish near market bottom. 2023, October, Bitcoin at 27,000. Market relatively quiet. SC, Bitcoin to 120,000 by end of 2024. Result, Bitcoin hits 73,000 by February 2024, then corrects. Forecast was early and bullish before the move. 2025, December, Bitcoin around 89,000 after hitting 103,000 peak. SC, lowering 2026 target from 300,000 to 150,000. The revision cuts their forecast by 50%. Result, Bitcoin consolidates, and according to ETF flow data, institutions continue accumulating. 2026, February 12th, Bitcoin at 67,000, down from 126,000 October peak. SC, lowering year-end target to 100,000 from 150,000, could drop to 50,000 before recovery. The pattern that emerges from this data. Forecasts tend to become bearish after declines and bullish during rallies. One interpretation, they're simply reacting to market conditions with conservative analysis. Another interpretation worth considering, the timing of these forecasts creates interesting conditions for certain market participants. But here's what's worth understanding about market structure. Standard Chartered's primary revenue doesn't come from retail investors. Their business model centers on institutional custody services, prime brokerage for hedge funds, treasury management for family offices, investment banking for large corporations, structured products for high net worth individuals. When Standard Chartered publishes research, the question worth asking is, who comprises their target audience? Their institutional client base, not retail participants on Twitter. And what might institutional clients need most when deploying large amounts of capital into Bitcoin? They need liquidity. They need willing sellers. They need volume. They need market conditions that allow them to accumulate significant positions without driving prices up prematurely. So the hypothesis worth considering, does research that creates uncertainty serve the interests of institutional clients looking to accumulate? This isn't an accusation of impropriety. This is analysis of market mechanics. Research influences sentiment. Sentiment influences behavior. Behavior creates price action. Price action creates opportunities. And sophisticated participants understand this dynamic. If this analysis is revealing something about market structure you haven't considered before, drop a comment. Market mechanics. Let's see who's following the logic here. But let's go deeper into the February 5th event itself, because the on-chain data reveals interesting patterns. According to Glassnode Analytics, the entities that sold on February 5th showed characteristics of short-term holders, coins held less than 155 days, wallets exhibiting loss aversion behavior, leveraged traders forced into liquidation based on exchange data, transaction patterns consistent with retail trading behavior. The entities that accumulated showed different characteristics. Long-term holder wallet signatures based on historical holding patterns, large institutional-sized transactions, addresses associated with known ETF custody providers, transaction patterns consistent with systematic accumulation strategies. This represents what analysts call a transfer event. Capital flowing from one category of participant to another, from short-term holders to long-term holders, from leveraged positions to spot positions, from emotional decision-making patterns to systematic accumulation patterns. Now, an important clarification, this analysis doesn't suggest anything illegal occurred. This doesn't imply fraud. This doesn't represent manipulation in any traditional legal sense. Standard Chartered publishes research. That's legal. Institutions accumulate during fearful markets. That's legal. Retail participants make their own decisions to sell. That's their choice. Everything described is within normal market operations, but that doesn't mean you can't learn from analyzing the pattern. Because here's what's worth understanding. The same data that institutions use to make systematic decisions is publicly available. The Fear and Greed Index is public. The realized loss data is public. ETF flow data is public. On-chain metrics are public. The difference between successful and unsuccessful market participants isn't access to information. It's the system used to process that information and make decisions. Some participants react emotionally to headlines and social media sentiment. Other participants execute systematically based on data thresholds and predefined criteria. And over time, wealth tends to transfer from emotional participants to systematic participants. Not through any illegal mechanism, simply through different decision-making frameworks responding to the same information. $3.2 billion, one day, from one type of participant to another, from emotional to systematic, from reactive to strategic, from short-term fear to long-term positioning. Hit that subscribe button because next, I'm going to show you exactly how to build a systematic framework, how to recognize these patterns in real time, how to position yourself advantageously during future volatility events. The goal isn't to make accusations. The goal is to understand market mechanics and position yourself intelligently. According to Glassnode Analytics, the entities that sold on February 5th showed characteristics of short-term holders, coins held less than 155 days, wallets exhibiting loss aversion behavior, leveraged traders forced into liquidation based on exchange data, transaction patterns consistent with retail trading behavior. The entities that accumulated showed different characteristics. Long-term holder wallet signatures based on historical holding patterns, large institutional-sized transactions, addresses associated with known ETF custody providers, transaction patterns consistent with systematic accumulation strategies. This represents what analysts call a transfer event. Capital flowing from one category of participant to another, from short-term holders to long-term holders, from leveraged positions to spot positions, from emotional decision-making patterns to systematic accumulation patterns. Now, an important clarification. This analysis doesn't suggest anything illegal occurred. This doesn't imply fraud. This doesn't represent manipulation in any traditional legal sense. Standard Chartered publishes research. That's legal. Institutions accumulate during fearful markets. That's legal. Retail participants make their own decisions to sell. That's their choice. Everything described is within normal market operations, but that doesn't mean you can't learn from analyzing the pattern. Because here's what's worth understanding. The same data that institutions use to make systematic decisions is publicly available. The Fear and Greed Index is public. The realized loss data is public. ETF flow data is public. On-chain metrics are public. The difference between successful and unsuccessful market participants isn't access to information. It's the system used to process that information and make decisions. Some participants react emotionally to headlines and social media sentiment. Other participants execute systematically based on data thresholds and predefined criteria. And over time, wealth tends to transfer from emotional participants to systematic participants. Not through any illegal mechanism, simply through different decision-making frameworks responding to the same information. $3.2 billion, one day, from one type of participant to another, from emotional to systematic, from reactive to strategic, from short-term fear to long-term positioning. Hit that subscribe button because next, I'm going to show you exactly how to build a systematic framework, how to recognize these patterns in real time, how to position yourself advantageously during future volatility events. The goal isn't to make accusations. The goal is to understand market mechanics and position yourself intelligently. Now contrast Marcus's emotional journey with the systematic participant Victor. 7 a.m., February 5th. Victor checks Bitcoin price, 68,000. Checks system dashboard, Fear and Greed Index, 26, neutral. Bitcoin price versus 200-day moving average, 18%, moderate deviation. Network fundamentals, hash rate at all-time high, positive. ETF flows, negative, but showing signs of stabilization. System status, monitor closely, prepare for potential accumulation if fear index drops below 12. Victor experiences no emotional response. He's collecting data points. 9 a.m. Fear index drops to 18, Bitcoin at 66,000. System, approaching threshold, maintain observation. 10 a.m. Fear index hits 14. Bitcoin at 62,500. System, threshold approaching, prepare capital deployment strategy. 11 a.m. Fear index crashes to 5. Bitcoin at 61,000. System triggers, extreme fear, threshold met, execute accumulation protocol. Victor executes predefined buy orders. 25% of allocated capital at 61,500. 25% at 60,800. 25% reserved for lower prices. If decline continues, 25% reserved as permanent dry powder for even more extreme scenarios. Zero emotional involvement. Zero fear. Zero second guessing. The system indicated accumulation. He executed. That evening, Victor reviews the day. No celebration, no regret. He executed his systematic framework during extreme fear, identical to his approach during March 2020, November 2022, and every other capitulation event. Average cost basis, 61,150. Today, February 12th, Bitcoin at 70,200. Victor's position, approximately 15% unrealized gain in 7 days. More significantly, Victor's emotional state remains completely neutral. Whether Bitcoin rallies to 80,000 or declines back to 60,000, his system will indicate the appropriate response. He doesn't need to predict. He doesn't need to hope. He doesn't need to feel. He executes based on data thresholds. If you want to develop systematic approaches rather than emotional reactions, comment, build the system. That's your commitment to data-driven decision-making. The difference between Marcus and Victor isn't intelligence, isn't access to information, isn't even capital size. The difference is the decision-making framework. Marcus operates on emotion, social proof, and headlines. Victor operates on data thresholds, predefined criteria, and systematic execution. And in markets where wealth tends to transfer from emotional participants to systematic participants, that difference compounds dramatically over time. Let me give you Victor's exact framework principles. This isn't financial advice. This is analysis of how systematic participants approach markets differently than emotional participants. Principle 1, never make decisions during extreme fear. The data shows that when the fear and greed index drops below 12, historical patterns suggest you're likely near a bottom rather than a top. Data points, COVID crash, fear index 8, Bitcoin potom 718% over next 18 months. China ban, fear index 10, Bitcoin plus 146% over next 7 months. FTX collapse, fear index 6, Bitcoin 74% over next 21 months. February 2026, fear index 5, recovery of 17% in 7 days. The pattern is consistent. Extreme fear below 12 has historically preceded recoveries rather than continued declines, not 100% of the time. But the statistical probability favors accumulation over capitulation. So why do participants still sell during extreme fear? Because executing against emotional impulses requires systematic discipline, a potential framework. If fear index is below 12, I only consider buying or holding. Selling is removed from consideration. This removes decision fatigue during high-stress moments. Principle 2, question information sources. When major institutions publish dramatic forecast revisions, consider asking, who might benefit from this narrative? Standard Chartered benefits from their research in multiple ways. Client service. Their institutional clients who seek to accumulate might benefit from retail uncertainty. Transaction revenue. More volatility typically generates more trading activity and fees. Media attention. Dramatic forecasts generate coverage, building brand recognition. None of these necessarily align with retail participant success. A potential framework. When institutions publish dramatic forecasts, consider that their incentive structure may differ from mine. This doesn't mean forecasts are always wrong. It means understanding that different market participants have different incentive structures. Principle 3, observe actions over words. This represents perhaps the most valuable principle. Standard Chartered's research suggested Bitcoin could go to 50,000. BlackRock's ETF flows showed accumulating $26.5 million on February 11th. Michael Saylor's statements, we're buying Bitcoin every quarter forever. Strategy's actions, purchased 142 BTC for $90 million between February the 2 to 8. Which signal provides more valuable information? The forecast or the actual capital deployment? Systematic participants track, ETF flows updated daily, on-chain wallet movements updated continuously, corporate treasury purchases announced publicly, exchange balance changes updated daily, mining entity behavior tracked weekly. These represent actions. Actions reveal actual positioning. Words create narratives. Principle 4, develop mechanical criteria. The difference between a strategy and a system is specificity. A strategy, I'll buy when Bitcoin seems oversold. A system, when fear index drops below 12 and price falls below 200-day moving average and no fundamental protocol issues exist, I deploy 25% of allocated capital using dollar cost averaging over 3 days. Notice the difference? Strategy involves subjective interpretation. System provides mechanical execution criteria, a potential accumulation framework for extreme volatility. Trigger conditions, all must be met. Fear index below 12, price below 200-day moving average. No fundamental protocol issues or security breaches. Execution protocol. Deploy 25% of allocated capital immediately. Deploy additional 25% if price drops another 5%. Deploy additional 25% if price drops another 10%. Reserve final 25% for even more extreme scenarios. Reassessment conditions. Fear index rises above 75. Extreme greed. price exceeds 100% above 200-day moving average distribution signals appear in on-chain data. This framework removes emotion, removes decision fatigue, removes second-guessing. Principle 5, accept volatility as inherent to the asset. Bitcoin declined from 126,000 to 60,000. That's a 52% drawdown. If you cannot emotionally handle 50% declines without making impulsive decisions, Bitcoin may not align with your risk tolerance. Consider bonds or stable value investments instead. But here's the historical reality. Every major appreciation in Bitcoin's history has been preceded by significant volatility and substantial drawdowns. $20 to $200 to $200 to $20,000 to $3,000 to $69,000 to $1,500 to $400 to $73,000 to $60,000 to $126,000 to $60,000. The pattern shows consistent volatility. Systematic participants reframe this. Volatility isn't a flaw, it's the characteristic that creates the opportunity. The 52% decline creates the fear that creates the transfer that creates the potential for future appreciation. This mental model is critical. Emotional participants see volatility as a threat. Systematic participants see volatility as the mechanism that creates opportunity. Principle 6. Time horizon determines approach. If you need capital in 6 months, Bitcoin may represent inappropriate risk exposure. If your time horizon extends 4 to 8 years, short-term volatility becomes less relevant. Systematic participants often operate with minimum 4-year time horizons, ideally 8 to 10 years. This time frame allows them to weather multiple market cycles, accumulate during fear events, and potentially distribute during euphoric periods without being forced to sell during drawdowns. Principle 7. Position sizing prevents catastrophic errors. Never allocate more than you can afford to lose completely. Never use leverage. Never deploy all capital simultaneously. A potential position sizing framework. Bitcoin. Maximum 20% of investment portfolio. Entry strategy, dollar cost average over 6 to 12 months. Maintaining 25% dry powder for extreme fear events. Leverage, 0, under all circumstances. This sizing means that even a total loss wouldn't represent financial catastrophe. It would be unfortunate, but survivable. This removes the emotional intensity that drives panic selling. If you're committed to developing systematic approaches, drop a comment. System over emotion. Share this analysis with someone who might benefit from understanding these frameworks. These 7 principles form the foundation of Victor's system. Not complicated, not requiring special access, not requiring millions in capital, just discipline, mechanical execution, data-driven decision-making. The framework that potentially positions participants advantageously in markets designed to transfer wealth from emotional decision-makers to systematic executors. Here's what's worth understanding. February 5th, 2026. Likely it won't be the last time this pattern occurs. This dynamic, uncertainty creating retail fear, creating wealth transfer, has appeared in every major market cycle throughout history, and the pattern will likely repeat, perhaps next month, perhaps next year, perhaps in 2028 during the next cycle. But historical patterns suggest it will occur again. And when it does, you'll face similar conditions. Portfolio down 20, 30, potentially 40%. Social media expressing panic. Major institutions publishing cautious or bearish forecasts. Fear index at historic lows. Social proof suggesting you should exit before further losses. And you'll need to decide, do I make emotional decisions based on fear? Or do I execute systematic criteria based on data? Do I react to headlines? Or do I follow predefined thresholds? Do I become Marcus? Or do I become Victor? Because markets are systematic mechanisms. They don't consider your emotional state. They don't account for your financial needs. They don't adjust because you need prices to appreciate. Markets systematically test participants' decision-making frameworks, and wealth tends to transfer from those making emotional decisions to those executing systematic approaches. This transfer is legal. This transfer is predictable. This transfer follows measurable patterns. The question is, which side of the transfer will you be on? Let me show you what typically follows events like February 5th, because the cycle is remarkably consistent. Stage 1. The capitulation, where we were, asset down 50% plus from peak, fear index at historic lows, retail selling based on fear, institutions accumulating based on data, billions in realized losses. Stage 2, the recovery, where we are now, February 12th, asset bounces 10 to 20% from lows. Fear index rises from 5.8 to 12.15. Retail psychology, I'll wait for lower prices before re-entering. Institutions continue systematic accumulation. Stage 3, the consolidation, coming weeks as months. Asset trades range bound for weeks or months. Volatility decreases, media attention fades. Retail assumes the uptrend has ended. Institutions complete accumulation phases. Stage 4, the breakout future. Asset breaks above previous resistance levels. Fear index climbs to 40-50. Retail psychology. Is this the actual bottom? Still paralyzed from previous selling, many don't re-enter. Institutions reduce accumulation, prepare for distribution phases. Stage 5, the rally, future. Asset makes new all-time highs. Potentially $150,000, $180,000, $200,000. Fear index hits 75-85, extreme greed. Retail FOMO intensifies. I can't miss this opportunity. Everyone becomes an expert again. Stage 6, distribution, future. Asset at new highs. Retail buying aggressively. Institutions systematically distributing. Then another unexpected volatility event. Another round of uncertainty narratives. Another fear index collapse. Another multi-billion-dollar transfer. And the cycle potentially repeats. Emotional participants like Marcus sell during stage 1. Don't buy during stages 2 or 3. FOMO buy near the top of stage 5. Sell again in the next stage 1. Systematic participants like Victor accumulate during stage 1. Continue accumulation in stages 2 and 3. Hold through stage 4. Begin distribution in stage 5. Hold cash during stage 6, waiting for the next stage 1. Same market. Dramatically different outcomes. This isn't prophecy. This is pattern recognition based on 15 years of Bitcoin market history across multiple cycles. If you recognize this cyclical pattern and commit to positioning yourself advantageously, drop a comment. Pattern recognition. Now here's what's critical to understand. I can provide the analytical framework. I can show you the historical data. I can explain the psychological dynamics, but I cannot execute your decisions. Only you can determine whether to develop the discipline required to execute systematic approaches when emotions suggest otherwise. Only you can decide whether to invest time understanding market structure rather than simply reacting to headlines. Only you can determine whether you want to be Marcus or Victor. Because here's the reality. Most participants will likely remain in Marcus's pattern. Most will probably sell during the next major decline. Most will likely buy during the next euphoric peak. Most will potentially transfer wealth to systematic participants repeatedly, not due to lack of intelligence, but because developing and executing systematic approaches requires time investment to develop frameworks, discipline to execute against emotional impulses, patience to wait for optimal conditions rather than forcing actions, humility to accept that not every moment requires trading, and many participants aren't willing to invest that time, discipline, patience, and humility. They seek gains without systematic frameworks, returns without disciplined processes, outcomes without methodical work, and markets will consistently transfer wealth from those seeking shortcuts to those following disciplined processes. This isn't pessimism. This is realistic assessment of human psychology and market mechanics based on historical data. But you can choose a different path. You can develop systematic frameworks. You can execute based on data rather than emotion. You can position yourself advantageously for future volatility events. The analytical tools are available. The data is publicly accessible. The frameworks are proven by history. The question is, will you implement them? So what does all this data suggest? February 5th, 2026. $3.2 billion transferred from one category of participants to another, the largest single-day capitulation in Bitcoin history. Was it simply natural market forces? Or does the pattern suggest more systematic dynamics at work? The data points to both. Markets correct naturally through supply and demand dynamics. But the timing and narrative around those corrections often create conditions that amplify wealth transfers from emotional participants to systematic participants. Standard Chartered's cautious forecast on February 12th, the selling pressure that triggered liquidations on February 5th, the media amplification of fear narratives, the fear index collapse to historic lows, the institutional accumulation during maximum fear between February 10th and 12th, all operating within legal market mechanics, all following predictable patterns, all creating significant transfers of wealth from those making emotional decisions to those executing systematic frameworks. Now you face a choice. You can close this analysis, return to social media for trading signals, continue making emotional decisions based on headlines, and potentially provide liquidity during the next transfer event. Or you can commit to developing systematic frameworks, mechanical, data-driven approaches that execute consistently during extreme fear and extreme greed. Frameworks like the ones we've analyzed today. If you made it this far, comment, "I made it." I want to see who the real diamonds in this community are. See you in the next video.